While everyone was watching the protests in DC, maybe Bitcoin, the stock market, or maybe the Kardashians, did anyone notice what happened to interest rates? Well, let's take a look. As you can see from this chart here, after very slowly moving up over the past several months, the yield on the 10-year U.S. Treasuries poked above 1% and actually hit 1.052%. And in the chart, you can see the ascending triangle in blue and the breakout of interest rates toward the right of the chart. In technical terms, this could signal higher rates may be on the way. For me, it was a small sign that the economy was improving from this summer. And this is part of the reason I went more into commodities and specifically oil. If you listen to the pundits, the reason for the breakout is that Democrats are now in charge. This will likely pave the way for more spending, more stimulus, and a gaping budget deficit, as if we don't already have one. In turn, this will push inflation expectations further and nominal yields much higher. And this may be true in part, but as you can see, the rates have been moving for months. And regardless of your views on politics, higher rates were in the cards one way or the other. Perhaps no one was watching because no one cares since the Fed telegraphed it would step in with some form of yield curve control. But what if the Fed's willing to let yields run a bit? In my opinion, a rising yield is one of the biggest risks the market is unprepared for because no other asset in the world is as mispriced. The 10-year U.S. Treasury yield is just way too low. This is a significant consideration for investors because nearly every asset in the world is dependent on the 10-year U.S. Treasury yield. And just consider this, using the S&P 500 index as an example, an increase of 1% in the 10-year U.S. Treasury yield from current levels would lead to a huge decrease in the price to earnings multiple. And an increase in interest rate means a lower stock market. So, in the meantime, let's take a quick look to see what the charts say. And we're now looking at a 2-year weekly chart on the 10-year U.S. Treasury yield. And in the upper left, you can see the symbol. It's $TNX. And we're using stockcharts.com. And looking at the price chart here in the middle, you can see that point there in early March was the bottom of that drive all the way down there. Now, a few months later, we successfully tested that level and we reflected on up. And that move on up here is a line drive. You can see that here in the MAC. Now, fast line came through, rates dropped, bottomed and based here, and then the fast line moved through the slow line on up this direction. Now, as you can see that the fast line is very close to the slow line. And we've talked about this in the stock market, particularly with the SPY, and that to me looks like a melt up. So we were having a melt up in the interest rates, and it looks like there's no stopping. It appears that this can continue for some time. Now, in the upper portion of the chart, we're looking at the RSI, which is the Relative Strength Index. And you can see that the bottom here coincides with the bottom in the price chart. And from this point here, we sort of meandered our way on up here, slowly but surely. We moved past that 50 or midline back in September-October period, but it continued on the way up. And I don't think it's done. So I think this is going to continue on. I think interest rates are also going to continue. There may be a pause as we popped above that 1% and people will start taking notice. But for the most part, I think the future, we have higher interest rates on the way. And for today, that's ChewDog Charts. Thank you.